Would you like an opinion on a financial matter you're dealing with? Whether it's about retirement, investments, taxes, or 401ks, Scott Hansen and Pat McLean would like to help you by answering your call. To join Allworth's Money Matters, call now at 833-99-WORTH. That's 833-99-WORTH.
Welcome to Allworth's Money Matters. Scott Hansen.
Pat McLean, thanks for joining us.
Yeah, glad you are here. We're both financial advisors, certified financial planner, chartered financial consultant. We've been doing this program, our financial advisors during the week, but then we broadcast this program on the weekends.
Yes.
By the way, if you're listening to the radio, fine, but like everything's moving to podcast. Like we have way more podcast listeners than we have terrestrial radio.
Yes.
And you'll notice the format of our show is already kind of morphed away from radio, designed more for podcasts. Cars today, some new cars don't have AM radios. Like it's not that hard to listen to something portably.
Oh yeah. So what you're suggesting, if you're listening to AM radio and waiting for it every week, go ahead and subscribe.
I ran into someone at the supermarket this week. That's what got me thinking about it. Hey, I love your show. I always make sure I have time set aside on Saturday to listen. So
I listen when I'm walking out to pick up the morning newspaper.
My neighbor still gets it.
I miss it.
The paper itself?
I do miss it. I
haven't touched a physical newspaper in years. I have no desire to touch one because you get the ink on your fingers.
Oh, I got to tell you,
trying to fold it.
I used to really enjoy like a Sunday morning sitting in the backyard reading the
I
New
think
York
they
Times.
Still have a Wall Street Journal delivered here. I see it in the break room.
Oh, I checked on that because there's a bunch of them, and I said, who's paying for this? And no one pays for it. They don't actually know. No one in our company's getting billed for the Wall Street Journal.
Maybe they just send them automatically.
Our receptionist actually called them, and they said, "Don't worry about it. We just send it to certain businesses." There you go. But anyway, back to the show.
But anyway,
stock market.
Holy smokes! What an interesting week.
Yes.
This last week. First of all, the Dow touched 40,000.
And as of this taping,
which is Friday a.m.,
right at 9 a.m., it's not at 40.
Yeah, but
it could be by the end of the day.
And I just thought it was really interesting because, it's like a sauna in here. I don't know why it's so hot.
I know. Can we?
I don't know.
Okay. No one knows why.
No one knows. It is. Yeah.
It touched 40,000. But what's interesting is I was listening to another podcast, and they were talking about the returns of how not that long ago it was at 10,000, the Dow.
Right. That's what I was thinking this week.
Yeah, but do the math.
It's been a long time.
It's been 15 plus years. And if you do the math, that's an annualized 10% return from there to there. It seems like a big number.
It's not.
But it's not.
Well, so we've been in this industry a long time. And I remember in the 90s, there was the book, it's like the Dow 20,000. Remember that?
Oh,
Someone came out.
Harry Bent.
No, he said Dow 1,000 or something. He was predicting a decline.
Oh, it was the other economist.
He was way off.
Oh, yeah.
Anyway, maybe I got the numbers. And at the time, there's big debate. Oh, that's such a far number. I mean, it's not going to be long before we're at 100,000. A million.
Oh, yeah, okay. Not in my lifetime. 100,000, most certainly, hopefully.
Well, one would think it's not that much of a growth from here.
Yes, that's right. So it looks like a big number, but it's not. And what has the stock market, let's say the S&P 500 done historically?
Well, the broad market's done about 10% a year, about 7 percentage points greater than the rate of inflation.
That is historic, which is why you actually...
And cash, CDs and stuff have done about 0.5% better than
which is why you actually own stock. Is
ownership of companies over long periods of time.
Is a great hedge against inflation.
But it was just watching the market. It would touch the 40,000. And it's always easy when the markets are going up. It's not actually, if you're on the sidelines, it's really hard. If you've pulled out thinking that it's too risky, and then the pain of being out of the market while it's going up might even be worse than the pain of going through the ride. You think about those that pulled out during COVID.
Well, Scott, yes, I'm going to agree with you. If they don't have an underlying thesis that isn't emotionally based.
Yes, if you're getting out because you're going to use the money for a vacation home in 3 years or kids' college, then
but the people that do it on an emotional basis, like I met with a client last week, and he said to me, actually this week, he said, "Yeah, 3 of my friends are out of the market because of these reasons." And he listed a couple of reasons, and he said, "What do you think, Pat?" And I said, "Oh, I think that they're creating reasons to justify their actions." I said, "I don't think that any of those reasons
they're out of the market.
They're out of the market because of the political uncertainty, economic uncertainty surrounding the Ukraine, all kinds of reasons." And I said, those are reasons that are justifying. They're trying to justify their emotional reaction to the marketplace.
So my guess is these guys are probably retired.
They're retired.
They probably don't have advisors.
They do not have advisors. That's right.
Why do I need an advisor?
That's right. That's right.
So they've been sitting on the sidelines for who knows how many months? I mean, the market's been
it's on a tear.
9 months has been up dramatically.
Yes.
Dramatic the last 9 months.
Yes.
Yeah. And if you're out of the challenge is if you miss those big swings like the last 9 months,
that over the long term, that has a radical impact on your returns.
Yeah, you might get 3 years worth of returns in a 6-month period of time.
Yes, and then nothing down.
Right.
Nothing down.
Correct. That's how it works.
That's how it's a risk premium.
Yeah, so I remember when the Dow hit 10,000, that was right in the year 2000, right at the top of the .com thing, if you remember that. The NASDAQ had touched 5,000 on the way to 6,000 or whatever at the time. Of course, then that was a peak. That all fell back. Then we went way past that. Then we had the financial crisis, pulled things much lower, below 10,000.
Yes. God, you remember back to the financial crisis. It seems like yesterday.
Yeah, it was 17 years ago.
Wow.
A long time ago.
But
I think the one thing that's helpful, Pat, I mean, we've been doing the show a long time. We've been in this industry a long time. When you live through these experiences, it's one thing about studying history and getting all the facts, right? But then when you've lived through them personally and you've guided clients, navigated through those times, and the thesis is that these are all temporary and they're going to recover and we're going to hit new highs again.
This too shall pass.
And when we're young in this profession, we believe that based upon history, empirical knowledge. But today we believe that not just based upon what we've learned from others, but what we've personally experienced ourselves.
And the emotional turmoil that actually it takes to get through markets. So talking to a person the other day and they said, "Well, what do you think about your portfolios?" I said, "Look, our portfolios they're designed to do what they're designed to do." I said, "I never worry about the markets of the portfolios. I worry about clients' reactions to the markets of the portfolio. I worry about my own reaction to the markets and the portfolios." Right? Because you got to look, your advisor is a human as well. Your friends are human. They will weigh in and have influence upon you. Right? So had my client that said, "Oh, my friends are out of the market," and I gave him this kind of, "Well, that might not be a bad idea," which I did not. But if I had said that, the client would be like, "I should probably get out of the market as well," because it has a tendency to move into groupthink.
Well, and to push things further, like an advisor needs to build the best portfolio regardless of what you feel about it.
That's right.
Because, and I remember as a young man, Pat, it's funny you get these experiences. A client of mine who was really frustrated about one particular holding in his portfolio, and he says, "Scott," and he was one of these guys that was nervous all the time. He'd come in every quarter, scared. He was just he was a nervous investor to begin with, and I had a really balanced portfolio. Frankly, he passed away early because of a health issue, but his wife's still a client. They've done extremely well following basic financial planning principles, basic principles.
Nothing too exciting.
No. But I remember there was a particular, he comes in, he's like, "Scott, you must not be paying attention. Look at this fund you have in my portfolio. Why in the world do you have this fund?" And I remember,
because it was doing poorly.
it was doing poorly.
Okay.
And so I remember doing some research. It was doing poorly for two reasons. One, that particular sector of the market was out of favor at that particular time.
It happens.
It happens. And in your portfolio today, you have some things like that.
You hope to.
I have things like that. Our clients have things like that. Things that just aren't, they're out of favor right now.
The question,
Small cap value or whatever it might be at the time.
the problem is they could come back into favor tomorrow. You just don't know.
Well, the Magnificent Seven, which isn't really even seven anymore, that you realize that if you looked at how those returned over the last couple of years, essentially flat because the big downturn they had
Yes.
in 2022. Anyway,
So back to your client.
So I do some research. I'm being very full disclosure here, right? Because there's a lot of psychology in being an advisor. And I look at the fund,
And an investor.
And I look at this fund. It is underperforming because, one, it was out of favor, the underlying sector. Second, the manager. It was an active managed fund. It's a long time ago. Active managed fund. It wasn't happening. And I thought one can make an excuse for firing this fund manager and replacing it with something else. And I realized if I capitulated to my client,
And it wasn't bad. It wasn't great. It
Correct.
was middle of the road.
correct. And so I said, Bill, I did the research. I'm not making one change to the portfolio. I stand by this portfolio. And as the years went on, he would come back to me and say, Scott, I'll never forget the time that I wanted to make some changes and you didn't want to make changes, and you risked losing me as a client to do what you felt was in the best interest of me. He says, so it was that moment on that I had full trust and confidence in you, and I no longer looked at my portfolio, which was true. Never, yeah. And it was one of those things that was it was interesting. And a good advisor, if you're not working with an advisor, I hope you really know what you're doing.
Yes.
But if you're working with an advisor, make sure that advisor has a portfolio that they believe is in your best interest, not the one that
makes you happy.
That makes you happy.
That's true.
Because you see it. People come in here and they're like, someone comes shopping for a new advisor. No one goes shopping for a new advisor because their relationship's perfect.
Oh, correct.
There's something wrong, right? So
yes.
They come in.
Or yes, either firing an old advisor or engaging a advisor for the first time. Either they are unhappy with it. They're unhappy in the situation they're in.
But how many times have you seen where you look at the portfolio and you're like,
how'd that get in there?
Right. Wow, you're way overweighted in this, you're way underweighted in that. And then you start having a conversation and you realize it was the client that had been driving the relationship and driving the investment portfolio, not the advisor. It was a weak advisor.
Yes. See it all the time.
Yeah. So anyway.
With the Dow at 40.
And this last week, Roaring Kitty came back.
Oh, this.
Deep,
They
have two names, Roaring Kitty and Deep something value. I'm not even going to. Right?
Yeah, Roaring Kitty. All right, bring us up to date on Roaring.
By the way, if you've
this
not
is a
seen
serious financial show, but bring us up to
if
date.
you've not seen the movie Dumb Money,
oh, you've got to watch it.
I mean, if you're interested in this sort of stuff.
Look, so this gets back to actually what goes in favor and out of favor so quickly, Scott, is it's groupthink. I was thinking when we were talking about pushing things up, the .com. Now, if you've listened to this program at all, you join the .com. Say, Scott and I in 99, 98, 99, were like, this is crazy. This makes no sense, right?
That's right.
That makes no sense. Well, that was groupthink on the way up.
That's
like,
right.
There's no end. But groupthink actually, in the short term, can drive markets down. A negative market sentiment that just is
Absolutely. The same thing.
pervades, right? This Hello Kitty, Roaring Kitty, whatever.
Roaring Kitty. So this all comes back the GameStop.
Yes. By the way, if you're still buying software at the mall, you might want to reconsider.
Games. You go in and exchange your games.
Well, okay.
I
don't know.
I just remember my son's 26 now. When he was a little kid, would go to GameStop because you can sell in an old game and buy a new game, and he'd save up his allowance or whatever, and we can get him some new. Anyway, but if you've been following the financial markets, you've obviously a couple of years ago these stocks were crazy, and GameStop, which looks to me like a company that should not exist. No one would come up with a business model today to go to brick and mortar for software. But the stock was bid up enormously. And it was hilarious because...
And there was a theater chain as well.
AMC.
Okay.
There's a few others, actually.
Okay, yeah, there was a bunch.
Anyway,
right.
so then this thing came crashing down, and it was revealed who someone doxed Roaring Kitty, and it was revealed that he was this guy working out of his basement, and I think he worked for an insurance company in their portfolio department or something like that.
Oh, yeah. He had a securities license.
Correct, yeah. And so then he went dark. He was subpoenaed before Congress. Then he went dark. He was resurrected this week. So he's back, yeah. He came back, sent out, he tweeted, is it still tweet on X? He X'd a photo of himself leaning in. I don't know if you saw a little cartoon. That's all it was.
Oh.
Midweek, last week, and these meme stocks shot up again.
Just because he said we're going to do it again?
He said nothing. He'd been dark for so long, he sends out this meme, this cartoon of him leaning into the computer, like he was leaning back, now he's leaning in. People excited, like Roaring Kitty's back, and here goes the stock again. And
well, I got to tell you, Scott.
More ways to lose money.
You used two words in that last story that weren't around. You used the word meme.
Correct.
And docs. And actually, so I was with my brother. And
I had to use docs. I read it this weekend. I'm like,
oh.
And I thought, it's interesting how these words just come out of nowhere. I don't know where they start.
So I was with my brother, and he was reading an article, and he looks at me. We were traveling together, and he goes, what's docs? And I said, well, I think it's when you like call 911 on a house, and you say that someone else's house is being broken into. And my sister-in-law says, no, that's swatted. Swatted. Where you are calling in order to harass someone, you're calling 911 on someone else's house. Because in a cell phone, they don't know who's, right? People use cell phones. So my brother and I are like, what's dox mean? So we had to actually look it up. And dox is
revealing someone's personal information, their home and address. And
well, for the rest of the old listeners like myself. And a meme is a cartoon character, some sort of
something that's supposed to
represent you.
Something else, right?
Yes. Okay, well, thank you for that.
I guess. I mean, I know. I haven't thought about putting a definition on
a meme.
Different.
Like a meme is a depiction. Let's go with that.
As my 16-year-olds will say, Dad, that's not a thing. Or, Dad, that's a thing. That's a thing. Like, what? It's a thing, Dad. That is? I never heard that. It's a thing. Yeah, where have you been? It's a thing.
It's a thing.
Anyway, let's go to some calls. By the way, we tend to record during the week, and we'd love to take your call. One of the favorite things we do, actually, is take calls from our listeners and help them through some financial planning. So if you are looking at, maybe you're wondering if you got the right kind of portfolio, questioning if you're in a position to be able to retire today, trying to figure out how to have your portfolio designed to keep pace with inflation, or maybe it's an estate planning question you've got, anything related to finance, would love to have a conversation with you. And you can simply there's a couple ways. One is you can send us an email at questions@moneymatters.com, and we will schedule a time. So questions@moneymatters.com. Or on Friday, May 31st, we've got a special couple hours just in the studio, a call session. We'll be in the studio just taking calls Friday, May 31st. We're doing this from noon Pacific to 2 Pacific. So 2 hours, noon to 2 Pacific, Friday, May 31st. So we can either schedule it during that time or schedule another time we're doing it. Again, just send us an email, questions@moneymatters.com. And
let's go to let's actually go to the calls.
We're in Ohio talking with Betty. Hi, Betty. You're with Allworth's Money Matters.
Good morning.
Hi, Betty.
Hi. I was just calling to ask a question. I have about a little over $50,000, and I have about 7 or 8 years left before I retire. And I just want to know what is the best thing for me to do with this money to, better prepare myself for retirement. I've been on my job. I do have 401k. And I just want to know, should I, pay off personal loans, high interest credit cards, pay my car off, which I only owe another year or so on, just to free up cash and put some money in a Roth IRA. I've kind of read a little bit about them.
So Betty, what was the source of this $50,000? Where did it come from?
It came from a lawsuit, a payment.
Okay, so it was a one time. It wasn't saved over time.
One time.
And
no.
How old are you?
I am 59.
And are you married?
I am.
And does your spouse work?
Yes.
How much credit card debt do you have?
Credit cards itself, I would say it might be right at it should be under about 20, well, closer to about 15,000.
Okay, so here's what I want you to do, right? So you asked a specific question about this $50,000, and I'll give you a specific answer. But you need a financial plan in order to get to retirement. And one of those things is that you and your husband both max out your 401k, 403b, 457.
Yeah, what do you have in your retirement plan? What do you have saved in retirement plans?
Oh, I should have checked before. It might be 259, something like that. 259,000.
Okay, and for you, and how much for your spouse?
Well, it's separate, so I don't know what he has. Yeah.
Okay, you run separate.
Started a new job.
You run separate.
He just started a new job.
But do you run separate financial households?
No. We're in the same household.
Okay.
It's just that my 401k is different than what he has.
Got it.
We understand.
And do you own your home?
Yes.
It's paid
and
for.
We would like to, no. No, we still have a mortgage.
Will either one of you be receiving a pension at retirement?
Yes, he will.
How much
From a previous job he had.
how much do you owe on your car?
$14,000.
And what's the interest rate?
4.8.
Okay, and the income between you and your spouse. How much money,
There's
family?
probably about $160,000 a year.
Okay, so here's what I'd like you to do. I'd like you to actually, first of all, increase.
I would not take any of this and pay off the credit cards if your income's at 160.
Why?
Okay.
What was your income 2 years ago?
Well, since he just started the new job, it was probably about 60,000 less than that.
How long has he been out of the workforce?
Well, it's not he's been out of the workforce. He's been working. He's just switched jobs. So
you got a tremendous opportunity right now, right? So your family income went from 100,000 to 160.
Mm-hmm.
Right? You're nearing retirement. You're 7 or 8 years away from retirement.
You are grossly underfunded for your retirement.
Unless he's got $1 million in his 401k that we don't know about.
And a large pension. So you're grossly underfunded. So you called about this $50,000.
But you've got an opportunity over the next 7 to 8 years
to fix it.
Mm-hmm.
Mainly because
that's what I like to do.
You're in that situation. My concern is if you take this $50,000 and you pay off the $15,000 in credit cards, now you only have $35,000, and that you're never going to save that additional $15,000 that you just took to pay off the credit cards.
I'm going to disagree, Scott. I think that I got to tell you, she's 59. She's staring a retirement in the face.
It depends how serious you and your husband want to get about your finances.
That's right. And I'm going to bet
it depends on what? I'm sorry, I didn't hear you. It depends
how serious, and it's a husband. How serious the two of you want to be on getting prepared for retirement?
Your retirement, you don't have nearly enough money saved for retirement. Not even close.
Right.
Not even close. Based upon the numbers that you're sharing with us now on this $250,000 plus in your 401k, even if your husband has a good pension, you're grossly underfunded for retirement. So you called about this $50K, and I'm thinking, well, I'm going to answer that question, but you need much, much more than that.
Right.
Much more than
I mean,
that.
in a perfect world, we funnel those dollars into the 401ks by using catch up. They take that tax
I tried
savings.
that. I was told not to do that.
By
But
who?
Okay.
By who?
An
One
annuity
of the
salesman.
one of the advisors through our 401k were connected to Fidelity, I think it was, and not that he knew what he was talking about. I don't know, but he said that was not a good idea.
Well, he's wrong.
Okay.
To put more money in your retirement account?
He's
as
wrong.
You're underfunded for retirement?
So here's what I want you to do. I want you to pay off the credit cards right now.
Okay.
I want you to increase your maximum, the maximum into your 401k, including the catch-up provision. So you're going to increase as much as that pension plan could possibly take, every dime of it. I want your husband to put the maximum into the 401k or his 403b or 457, including the catch-up provision.
Here's what you like. If you really care about this, you guys need to sit down with a good advisor. Say, look, here's what we're trying to accomplish. We want to retire in 7 to 8 years. Here's what the kind of income we need. What's it going to take? And you could work backwards, and you could see exactly the path you're on now, and what it's going to take to get the path you'd like to be, and then maybe that's going to be somewhere in the middle.
Correct. But I want you to pay that car off too. Even though it's 4.8, it's about what you would receive in a bank account, in a high yield account.
High interest.
I want you to put the rest of the money in a high yield interest account and not touch it. So what we did is we lowered your monthly outflow on credit cards and car, and I took all that money that you were paying towards that and then some.
Put it to retirement.
And put it towards your retirement.
In the high interest savings.
No.
Maxing out your 401k.
401k.
That's
Sorry.
right. That's
Yeah,
right. That's right.
Okay.
So write this down. Maximum, including catch up for you and your spouse. Pay off the credit cards in the car. Put the rest in a high yield savings account. Get a financial advisor. Pay a couple $1,000s for a plan. Stick to it so that you have a comfortable retirement. Because I'm telling you,
you're in a great opportunity because your family income went. This $50,000 is nothing right? But
yeah,
what's pretty cool is that your husband's got a job now. Your family income went from 100 to 160,
and we want to take that 60,000 and put it away for retirement.
That's right.
I understand.
All right.
I did increase my 401k, but not to the maximum.
Well,
so
I would do the maximum with catch up.
With catch up, everything.
Okay.
Both
With
you and your
catch-up.
spouse.
But what we do believe, Betty, that if you go through the process of doing a financial plan, you'll see the benefit and how it's going to impact your life.
Which makes it easier to stick to the process because you know what the outcome will be.
Yeah, as opposed to I think this might be good for me.
It might be. This is what they say.
Or should we take that trip that we wanted to do anyway and go
to Jamaica, the Carnival cruise,
all that stuff that competes for your savings. So appreciate the call, Betty. Let's talk with Bob. Bob, you're with Allworth's Money Matters.
Hello, gentlemen.
Hi,
Thanks
Bob.
for taking my call.
Yeah, glad you joined us.
I ultimately have a Social Security question, but I think I may have come to it in a kind of a strange or roundabout way.
All right. Well, fire away.
I retired last August, thinking I was in good stead, had about 1.6 in retirement accounts, IRAs, 401ks, annuities, a whole spread of things. So I thought I was sitting pretty, and the house is almost paid for. I only own about $100,000 on a house. So I went ahead and retired. Well, I just found out we're going to get divorced.
Oh, gosh.
So that changes the calculations, or potentially changes the calculations dramatically.
Wait, were you both retired at the same time, or did your spouse?
No. She's 5 years younger, so she's still working.
Okay.
And I turned 64. I'll be 65 this December. So when I start thinking that I'm going to get half my retirement, and I still don't know the status of, because we both want the house, so I don't know whether I'll have a house or have to buy a house.
How long were you married?
Something else. We just passed our 10-year anniversary. March 1st is our 10-year anniversary.
And what state do you live in?
Michigan.
And why do you think it's going to be half?
because that's what all the marital assets. At least, no, that's a good point. There's a marital assets, and there's separate.
That's
assets.
right.
And
That's right.
thankfully, I think I have about 700 of the 1.6 is separate because it came from an inheritance.
No, wait, but look, you should be talking to an attorney first, not us. And the reason is
I have.
okay.
I am.
Typically, it's the marital asset that
It's only during those years that
the
you're
years
married.
that you were married. So this $1.6 million that you have saved up for retirement, some of that was saved prior to
That's right.
the marriage.
which would have had compound growth on it by itself.
But the growth doesn't. The growth is considered marital.
That's right.
So, but there's about it's just under 200,000 is the pre-marital.
Okay. And then
account. So I have 200 there, and then another 500 of retirement.
All right.
Of inherited. So I've got about 700 that's probably protected.
Okay.
But the other 900 is subject to, distribution.
Okay. So what's your question for us?
Well, the thought being is that, my concept that I have in my head is that, you should take Social Security right away if you don't really need it. And that if you really need it, you should wait and to maximize the amount. So now I'm going from where I didn't really need it. So I started taking it, at 63 and a half. And now I'm in a position where I might really need it or might need it. And so I'm thinking, do I
suspend it,
stop it, send it, pay the money back and hold off and, wait to take it.
Are you going to re-enter the workforce?
No.
You say
Retiring
that
was the happiest moment of my life.
Okay, you said that with such certainty. I wanted to test that.
Yes, no, I'm happy to be here. I'm just trying to do the best with what's going to be left.
Normal life expectancy?
Both my parents made it to 92, so I'm expecting to be around here for
if I were in your position, it sounds to me like this wasn't you weren't the one who called for this divorce.
Correct.
Right? And you're going to end up negotiating something, hopefully, instead of having the attorneys end up with all your assets. So that would be in a perfect world. I would suspend, if I were in your situation, I would suspend Social Security. For one, it's no longer an income you have coming in. Right? And you're saying,
right.
I would go with the mindset, look, I'm suspending Social Security. I'm going to wait till age 70 because now my finances are in complete disarray. And I'm concerned I'm going to need higher income down the road, so that's why you've done that, right? So now your family income, your income is not what it was,
right?
So just from a standpoint of now you're negotiating who gets what and all that.
Well, how old are you now?
64.
64.
So we got to worry about Medicare premiums as well.
I'm paying for medical right now. Being retired, I had to buy medical.
Yeah.
Anyway, so
they'll be on Medicare here.
It should
Yeah.
wash.
Yeah.
It should wash, I think.
And does your spouse have a pension?
No.
Okay.
I have a small pension, and Social Security right now. So
If
I got
I
about
were in your
$3,500
position,
coming in a month. But
and I don't know your marriage. I don't know. But I've seen enough couples go through this, right? This is not that uncommon, unfortunately. And look, gray divorce, they call it. Like it's up dramatically from where it was 20 years ago. And lots of people find themselves in this situation. And it's a 10-year marriage. You're going to do everything in your power to ensure you have as many financial assets. And she's probably going to do everything in her power to ensure that she has as much. So just from pure negotiation standpoint, if I were in your situation, I would suspend Social Security and state, look, given what's happened now to my life, I am concerned about having enough money in my old age, so I have to defer Social Security till age 70. Now that is no longer an income source that you've got coming in.
right.
That's just part of the negotiations.
I would agree with Scott.
Okay. Well, that's what the rule of thumb says.
And then when you start looking at assets, one thing is important to keep in mind, there's different assets have different tax situations. So if you look at $100,000 in a 401k and $100,000 in a CD, they're not, the $100,000 in the CD is worth more Then the 100,000.
You have to bring everything into its liquidation value, which means spendable money, including your house. So that house, and I've seen it, a dozen times where people come in, even with attorneys, experienced attorneys.
My house is 800,000. The 401k is 800,000. I'm taking the 401k. She's taking the house, or whatever.
And the 401k is the value is the face value, what the value is today, minus the tax liability. The house is the value of the house minus the liquidation cost, which is typically 5 to 6%. So they're not apples to apples. Just keep that in mind when you're going through the process.
I will. Thank you.
Yeah.
All right. Good luck, Bob.
Sorry about that.
Yeah.
Thank you.
Yep. It's interesting. You never know.
But I'm not in this marriage, so I don't know why I said I'm sorry. Maybe he's happy.
Okay. I don't think it
He didn't
sounded like this
he was
wasn't
happy.
part of the plan.
Yeah, he did.
Yeah, it sounded like something happened to him, not something he was looking forward to. But it's interesting, as we go through life, things happen. We can have the best financial plans. Spouse leaves us, spouse dies, we end up with a major illness.
Yeah.
Life happens. And usually it's that when life happens like that, it's usually a time when we got to relook at our financial plans and adjust accordingly.
The thesis changes.
Because your future changes.
That's right. The investment thesis changes.
Right. You had this plan of having retirement
Things
with a
change.
certain person. They're no longer part of your life. Like, what's retirement look like now? So,
Hey, every once in a while, we like to follow up with calls that we've had in the past. First of all, just out of personal curiosity.
Yeah.
Like, where did this go? Was our advice taken? If it was taken, was it taken in whole or part? And we like to call these things house calls for whatever reason.
yeah.
But it sounds like a fuller brush man. For those people that don't know what a fuller brush man is, it's a guy that used to come to your house.
It's one of those jobs I thought I'd like to do that for a day, just to try what it's like being a fuller brush man. It's a different era, but
So a fuller brush man is a man that would come to your house and sell brushes.
and that sounds quite sexist. Fuller, it could be a fuller brush female.
Okay, but very similar to how Amazon works today. But we like to follow up with these calls, and today we're going to talk to Brian.
That's right. We spoke to Brian last February, and he was in an interesting situation where you've got a parent is trying to do something to make everything even, and Brian's life was quite. Anyway, listen to the clip, and then we'll have a conversation with Brian. Have you owned a home in the past?
No, I've just rented just to keep my housing costs as low as possible so I can put away. Eventually I got to a good emergency savings and then eventually good 401k. And by then houses were rather expensive, and I'm not married, no kids. And then recently I like to travel. So I'm out of the country. Could be 3 to 6 months a year.
That changes things.
Yeah.
And so when you move out of the country, do you keep your rental or do you give it up?
Last time I kept it for about 3 months, but this time I'm thinking it's time to move on anyway, and I'm going to get rid of it.
You're
on the
gainfully
road.
employed?
Yes, and I can work remote, and I'm able to kind of do
People
both.
listen, I don't get this lifestyle.
Oh, no. Where did I go wrong?
I know.
Yeah, it's not bad.
So you sit down on an island and you actually have like a Photoshop bookshelf behind you when there's really a
And
beach?
Brian, you said you're 37?
38.
38.
38.
And what's your income ballpark from your employment?
150,000.
And what do you have saved?
Everything.
Everything 430,000, 300 of which is retirement tax advantage, and the rest is money market and index funds.
I hear that you don't want to buy a home.
Yeah, why would you want to buy a home?
Yeah, I don't. So it's like, do I convince my dad that, this is my strategy? I certainly appreciate the funds, and my thought would be to invest most of the money into VTI and maybe
Yeah,
take those
how old is
small
your dad?
chunks to fund travel. He's 74, and well, they're pretty well set for their retirement.
They're not
So
doing this for
taking
estate
away.
tax purposes then.
They want to even out.
No.
They've gifted their other
Yeah,
two
they're
kids.
going to give to. And what do you think of getting a rental home?
You know, I think it's kind of like I work in real estate as an accountant, and it's kind of like chefs in restaurants. They don't cook all day and then go home and make elaborate meals. And I think when I get home, I'm just tired of looking at real estate, and I prefer, my strategy is to focus on my time on my career, travel, and then passive investing versus most people I talk to don't like being a landlord.
Yeah, I don't like being a landlord.
I could live with it.
And then the house, at my index funds, I don't have to put
I get it.
furniture in them. I
You know,
don't
it's
have
funny.
to pay
So I'm going to tell you.
property tax.
So 2 days ago, I'm on a walk with my wife, and I said to her, actually, I'm on a walk with my wife, and I got a text from a property manager. Hey, can you please call me? And I like, is the house on fire? Right. And I text back, and the washer was broken, and he thought it's time to get a new washer and dryer.
Your mutual fund never calls you.
I said to my wife, and it's been a good investment but I said to my wife, I really love equities. And I said, here's the conversation we had.
You had this conversation with your wife on a walk.
She barely tolerated it, but yes. I was
How
trying
romantic.
No, well, and I said, that one of the benefits about getting a little older, you're still quite young. You didn't remember the pain of the financial crisis. One of the benefits of getting older, you've lived through all these cycles, and you see that the values of companies continue to grow. And when you look over the long-term return, you mentioned VTI, the total stock market index, you look at the long-term return of stocks, it's about 6 to 7 percentage points above that of the rate of inflation. It's hard to replicate that in any other asset class.
It is.
Real estate, rental, anything.
It is.
And it never calls you and says the washer's
And there's no
broken.
leverage in there, so the downside risk isn't as great.
Correct.
So, just tell your,
I would have a conversation. I'd have a conversation with your dad and say, "Look, my lifestyle's a little unconventional,
but I'm happy. I'm assuming you're happy.
I would love to take these dollars and invest them for the long term for my own financial security, just like my brother's financial, but in a slightly different way."
And I'd take it one step further. I would take a clip of this show and say, "Hey, I talked to these guys that I listened to their podcast, and this is what they said." And quite frankly, your dad may know. And by the way, that's the only way we're gaining listeners is one at a time. But it might change his view of the world enough that says, "Oh, okay, well, my son's taking this seriously," and he reached out to these financial professionals that manage, $20 billion, and they kind of under $19 billion, and they kind of understand it. So here's where you go, Dad, and see where it lands. But quite frankly, if I had a child like yours that said to me, "This is what I'd like to do," I'd say, "Okay, makes sense."
So, yeah. And so I have 4 kids, 28, 26, 16, and 13, right? Same wife, just a big spread. My oldest daughter, I just helped with the purchase of her first house. And I told my son, who's 26, I said, "Hey, 2 years from now, maybe sooner, but 2 years from now," actually might be then next year before the tax laws change, 2 years from now, I'm going to do something similar for you. But I already know he's just a different kind of guy. And for him, he's probably not going to want to buy a house.
At least at that point in time.
At that point in time. So I'll probably structure something different for him. Hopefully, he'll allow me to coach him some because this is my profession. But to help guide him in what to do. But I don't think it would be buying a home for him. But I would still feel the desire to let that
something that has similar economic value to that child.
Yeah, so he doesn't feel like I'm playing favorites. And I don't want to play favorites, and I want to help him get launched in life.
So, Brian, that's the answer to the question. I have a couple questions for you. Of these places you've traveled and worked, what was your favorite?
Oh, recently it would probably be Malaga, Spain. Although I almost don't want people to find out about it, but that was really.
Is that
really
the southern
good.
tip?
Yeah, that's in the southern tip. You can take a ferry to Africa, just about. But yeah, great weather. Has the old town. Has the beach. Got
I've actually
everything.
been to Malaga.
All right, second favor.
Second favorite.
Well, where do you plan on going next?
Lisbon was quite good.
I like
Lisbon's
Lisbon.
a great
I've never
city.
been to Lisbon.
That's
I
getting
like
a little overcrowded, but it was quite good.
Yeah, it's got quite
And
the
next,
American.
Next stop's Italy.
So, Brian, you're with us now, right?
Yes,
And are you overseas as we speak?
I am.
And out of curiosity, are you comfortable sharing where you're at?
Sure. I'm in northern Italy in Liguria in the Italian Riviera, in a small Italian seaside village.
Yeah.
That does sound pretty nice.
I was in Puglia a couple of weeks ago.
Of course you were.
We were yeah, but I don't live
With the Truly.
I don't live like Brian does. So anyway,
You're like a week and a half.
I know
Once a year.
Yeah, exactly. So I assume you're still gainfully employed.
I am. Yeah. So I've been here for a month, and it's working out well. And I took your advice.
Yeah, so how'd it go?
Yeah, it went good. I simply just shared the podcast with both of my parents, and Dad came around pretty quick saying, you're right. This sounds like it's the right thing for you to do, and it's an investment style that works for you, and plus you got your travel lifestyle. And I think he asked, that was the first comment, and the second comment was something about, are you going to get the tattoo on your foot? Because I think you guys said something about your son.
Okay.
Has a send it tattoo on his
I'm still waiting for my send it, but I have not sent it yet.
So this is a way that we could gain listeners to the podcast, Scott, is we could have.
So did they give you the cash?
I got $50,000 right before I left, which they had already sort of had in the works. I didn't really know. And then a bit more may come in January, so they can put it in a different tax year. And so I took the 50, and I immediately put 15 in a total stock market index fund, and then I'm sitting on 35 left over from that because I kind of took. I had a lot of changes going on. I was moving out of the apartment. The apartment's gone now. I have no costs back home, and I know when you talk to guests and they have it's not exactly the same, but when someone has an inheritance, you tell them don't do anything straight away while you're, going through
it's a little different
change or a life change. And so
this is a little different situation. We don't. I mean,
a little different, yeah. But so I'm sitting on now. I guess the follow-up question would be: I'm sitting on $100,000 in cash in a high-yield money market, and I probably just need to pull the trigger.
You know what you need to do. You don't need us to answer the question. You're just nervous
Brian,
about doing it.
It's always hard to invest because if the markets are up, you're like, man, it's on a tear right now. I'm going to wait until there's a pullback. And when the markets are going down, you're like, I don't want to invest right now. Things are going down. I'm going to wait until things are a little lower.
But you know what to do. You're just nervous about doing it. Just do it.
Okay.
Over the long term, it's not going to make. Look, who knows a year from now?
Or 2 years or 3 years. But what we do know is you're how old?
37, 6?
Right?
38.
38? Okay.
Yeah, you've got a long time. So just keep whatever liquid cash you need in the high yield, but that should not look. You laid out in that call we had a few months ago. You laid out your thesis, and now you've actually veered from it.
That's right. Human nature,
right? You told us what you should do, and then when you actually came time to do it, you didn't do it.
I parked it, but yeah, now I got to go.
Yeah, go do it.
It's not because it's not even the whole amount. It's the majority is coming next year in the future.
Yeah. So you know what to do. I have a couple personal questions for you. What after Italy? Where? Do you know?
I have no plan. I just kind of let things evolve or develop and ask people where to go. I wrote down Puglia when you said it a second ago.
Yeah.
And, I do have tentative plans to go to Paris in June to catch up with a friend out there for a couple weeks.
And when you travel like this, do you stay in an Airbnb or do you rent a room or?
Yeah, I'm in an Airbnb most of the time, and I actually made a little deal on this one. I rented it for a week, and then I met the landlord, and then once I tested the internet, and I had to do a lot of work this week, so I wanted to stay put for a while, and then I offered cash for an extra week, and it was a pretty good price on the cash price. And
Italy is relatively inexpensive right now because of the strength of the dollar. So anyway, hey, thank you for doing this house call, the follow-up. Appreciate it, and continue enjoying. This guy's living life.
Yeah, and I think there's two. I appreciate the call, Brian. There's a couple takeaways on this. One is if you're planning on leaving money to your kids, like the world's different today.
It is, and sometimes better from a warm hand than a cold heart.
Okay.
I had a client actually say that to me and then gifted 3 of his children money because the world is different.
So the question is the money that you're going to be either leaving at your death or while you're still there to help the child do what they want in their life or to do what you want them to do. Well, that's we're going to wrap up the program today. Hey, just want to remind, we mentioned earlier in the show, but want to remind you, we've got our call-in session. So if you want to join us on Friday, May 31st from noon to 2 Pacific time, we're going to be in the studio taking calls. Just send us an email at questions@moneymatters.com, or you can call 1-833-99-WORTH. This has been Scott Hansen, Pat McLean, Allworth's Money Matters.
This program has been brought to you by Allworth Financial, a registered investment advisory firm. Any ideas presented during this program are not intended to provide specific financial advice. You should consult your own financial advisor, tax consultant, or estate planning attorney to conduct your own due diligence.